Hello friends, today we are going to study about the Sebi Hidenburg controversy and the issues related to regulatory effectiveness. Role of regulatory bodies and issues related to regulatory effectiveness is a very important topic for both the UPSC as well as the Rajasthan State Civil Services exam. After the liberalization reforms of 1991, regulatory bodies have become all the more important because private players have also come into the market, and it has become essential to ensure a level playing field between the public as well as the private players. Regulatory bodies encourage innovation, support consumers, protect the consumers' rights, and provide stability to the economy. Now, in this video lecture, first, we will be studying in detail about the Sebi-Hidenburg controversy and the issues associated, like the conflict of interest involving the Sebi chairperson, the concepts like short selling, etc., and the manipulation of shares, the allegations of manipulation of shares that had been made by the Hidenburg company against the Adani group of companies. So all these we will be studying as part of the Sebi-Hidenburg controversy. Then we will be studying the issues relating to Sebi and the suggestions. That is the problems that are associated with the working of Sebi. The third thing we will be studying is the role of regulatory bodies, the problems associated with regulatory bodies, and the suggestions. Finally, we will be doing a few practice questions on all these topics. First, let us see certain concepts that we will be using in this video lecture. First is the concept of short selling. Now, what is short selling? Short selling means when a buyer borrows securities from a broker. So the buyer borrows the securities from the broker. When the market price of that security is higher, then the buyer will sell the security. Suppose the buyer sells the security for rupees 50. 50 is the market price and the buyer sells the security. Now when the market price falls, that is the market price becomes 30 rupees, the buyer then purchases the security. So in this process, the buyer will be making a profit of 20 rupees, and then the buyer will give back the borrowed security. So in this whole process, the buyer has made profit. This is known as short selling. Now in the Sebi-Hidenburg issue, a short seller known as Hidenburg is involved. Now Hidenburg was involved in short selling the shares of Adani group of companies. So Hidenburg would be borrowing the shares of Adani group of companies, then selling them when the market price was higher, and would be purchasing them back when the market price went down. So Hidenburg was in a way profiting when the market price of the shares of Adani group of companies went down. The profit would increase when the market price would go down. So this is the concept of short selling. Now short selling is of two types, covered and uncovered short selling. In covered short selling, the buyer is physically having the underlying asset, while in uncovered short selling, the buyer is not physically having the underlying asset. In India, only the covered short selling is allowed. Then the next concept is the Rule 19A of the Security Contract Rules 1957. According to this rule, every company listed in the Indian stock market must maintain at least 25% of public shareholding. That is, for every company, at least 25% of its shares should be with the public. So the promoter can own a maximum of 75% of the shares. The promoter cannot own more than this 25% more than the 75% limit. 25% of the shares have to be as part of public shareholding. So as we can see, excluding owners, promoters and their relatives. So the owners, promoters and their relatives, they can hold a maximum of 75% shares, and at least 25% shares should be with the public. And this does not apply to government-owned entities. Now in the Sebi Hidenburg controversy, what happened is that Hidenburg had alleged that there was misuse of this rule by the Adani group of companies, and Adani group of companies tried to manipulate the prices of shares in the stock market. Now what Hidenburg alleged in its report in June 2024 is that what Hidenburg said was that there were already a limited number of shares of the Adani group of companies in the market. That is, as part of public shareholdings, already there were a limited number of shares, and a large number of shares were owned by the promoters. Let us say, for example, let us suppose that the promoters, they were owning more than 70% of the shares, and the shares in the market were already very limited. And now what the promoters, that is the Adani group, did was that they tried to, out of this limited number of shares which were there in the market, out of these limited number of shares, the promoters, they tried to use foreign investments to purchase a large proportion of this public shareholding. So they tried to use foreign funds. They tried to route foreign funds to the Indian public, to the Indian share market, and they tried to use these foreign funds to purchase a large proportion of the limited number of shares which were there with the public. Now suppose, let us say 25% of the shares were there with the public, and the promoters, suppose they were owning 75% of shares, and now what the promoters tried to do is that they tried to route foreign funds into the Indian market. They tried to use these foreign funds to purchase a large proportion out of these 25% of shares. Suppose let us say that they tried to purchase half of these shares by means of foreign funds. So remaining shares will be 12.5%. And they tried to purchase half of these 25% by means of foreign funds. And these foreign funds, they were owned by the Adani group, by the promoters or their relatives. So they tried to use the money from foreign funds, which were their funds only. They tried to use this money to purchase the public shareholding. And by purchasing a large proportion of this public shareholding, there was a scarcity. There was a scarcity of the shares in the market, and because of this scarcity, the prices of the shares went up. And when the prices of the shares went up, the promoters profited. So in this way, they tried to make profits by means of this malpractice. That is, they violated this rule 19A of security contract rules. They tried to purchase a large part of the public shareholding, the shares of the Adani group which were there in the market. A large proportion of these shares was purchased by means of foreign funds to push up the price of the shares, and these foreign funds were owned by either the promoters or their relatives themselves. So they hid this fact, and they tried to manipulate the prices of shares in the Indian share market. So this was an allegation made by Hidenburg against Adani. And when Hidenburg made this allegation against Adani in January 2023, the prices of shares of the Adani group of companies, it fell all of a sudden. The prices of shares fell, and since Hidenburg was a short seller, now there is an allegation made against Hidenburg also. Now Hidenburg published a report in January 2023, and because of publishing of this report, which was alleging manipulation of shares by Adani, the prices of shares of the Adani group of companies fell. And it was alleged that there were allegations against Hidenburg that Hidenburg also profited from this falling of shares because Hidenburg is a short seller. And as we have just seen that a short seller would profit when the prices of shares would go down because Hidenburg was borrowing the shares, selling them in the market when the price was high and was repurchasing them when the price went down. And the more the price went down, the more Hidenburg profited. So there were allegations that Hidenburg did this deliberately to push down the price of shares of the Adani group of companies. So Sebi had also issued a show cause notice to Hidenburg in this case. Now let us see the story in brief after studying these concepts. Now last year, as we have seen in January 2023, Hidenburg had published a report regarding how Adani company had manipulated the shares in the Indian market by routing the foreign funds to purchase a substantial portion out of the limited public shareholding and to push up the price of the shares. We have already seen this. And also there were counter allegations against Hidenburg that Hidenburg is a short seller, and Hidenburg, since Hidenburg was profiting from the fall in shares of the Adani group of companies, so Hidenburg has deliberately done this. Now more than 40 research organizations, they conducted research regarding this report. Then there were petitions in the Supreme Court asking the Supreme Court to direct the CBI or a special investigation team to be set up to conduct the investigations. But Supreme Court said that they were happy with the investigation that was being conducted by Sebi, and hence they did not set up a special investigation team and they did not direct the CBI to conduct the investigations. Now under Article 32 and Article 142 of the Indian Constitution, Supreme Court has the power to set up a special investigation team in such cases when there is a conflict of interest. In such cases, when there is a conflict of interest, then Supreme Court has the power to set up a special investigation team or transfer the case to CBI. When there are certain circumstances where people who are overseeing the investigation, if we find that there is a conflict of interest, then a special investigation team can be set up and the case can be transferred to CBI. Now in this case also there was a conflict of interest which we are going to study in the subsequent slides. Now we have just seen that when the January 2023 report by Hidenburg was published, then there was a petition in the Supreme Court asking the Supreme Court to direct the CBI to conduct investigations and to set up a special investigation team, which the Supreme Court did not set up. Now Supreme Court said that although it has got power under Article 32 and 142 to set up a special investigation team and direct the CBI to conduct investigation, but this can be done only in exceptional circumstances. And Supreme Court did not set up this team, and Supreme Court did not direct the CBI to conduct the investigation. Now the question is that what are these exceptional circumstances? Was this controversy not an example of an exceptional circumstance? We'll study in detail in the subsequent slides. Now Sebi says that they have conducted investigations into various allegations made into the functioning of Adani group of companies. Now the allegation was that Adani group of companies had manipulated the prices of shares in the Indian market, and Sebi says that they have conducted investigations into it, but there is no report in the public domain regarding the findings of Sebi, and there is also no report regarding what penalty was imposed on the Adani group by Sebi. Then, as we know, Hidenburg is a short seller, so there were allegations against Hidenburg also. In June 2023, Sebi sent a show cause notice to Hidenburg company, asking them that why no action should be taken against them for their activities, because Hidenburg being a short seller was profiting from the fall in the prices of the shares of the Adani group of companies. So there were counter allegations that Hidenburg has deliberately published this report in order to bring down the shares of Adani Group of companies and to profit from the fall in the price as a short seller. So Hidenburg's report was subject to certain doubts also. So in June 2023, Sebi sent a show cause notice to Hidenburg asking them why no action should be taken against them for their activities. And concerns were raised regarding the functioning of Hidenburg research by Sebi. And also in the Supreme Court judgment, it was stated that how an entity can lead to such huge losses of retail investors in the market. So there were counter allegations against Hidenburg also. But Hidenburg has deliberately published this report to bring down the shares of Adani Group of companies and to profit from it as a short seller. And there are new questions whether Sebi has conducted the investigations impartially into the alleged manipulation of shares by Adani, into the allegations made against Adani by the Hidenburg companies. Now, recently this new question has come up because Hidenburg has published a second report. Hidenburg has published a second report regarding the conflict of interest involving the Sebi chairperson Madhabi Buch and her husband. Now, what is this conflict of interest? Hidenburg has alleged that Madhabi Buch and her husband had invested earlier in financial institutions which were set up in the tax haven of Mauritius. So in 2015, Madhabi Buch and her husband had invested in a financial institution in Mauritius in which the brother of Gautam Adani had also made an investment. And also Madhabi Buch and her husband had invested in the same fund which was set up by one of the directors who was working with the Adani Group of companies. So in this fund in Mauritius in which Madhabi Buch and her husband had invested, this fund was set up by one of the former directors of the Adani Group of companies. And in this fund, the brother of Gautam Adani had also made an investment. And there are allegations by Hidenburg that these investments, they were rooted into the Indian market and manipulation was done in the Indian stock market, violating Rule 19A of the Security Contract Regulations 1957. And manipulation was done in the shares of the Adani Group of companies in the Indian market and to push up the price of the shares by means of routing foreign investments. And by pushing up the price of by routing foreign investments, using the foreign investments to purchase the limited number of shares, using of foreign investments to purchase a substantial portion out of the limited public shareholding, the prices of the artificial scarcity was created. And the prices of shares was pushed up, because of which the promoters profited. So by creating high demand for shares, the price of shares was pushed up. So Hidenburg report had made these allegations in January 2023. Then there were counter allegations against Hidenburg that since Hidenburg is a short seller and Hidenburg is profiting from the fall in prices of the shares of the Adani Group of companies, so Hidenburg has deliberately published this report and this report may not have much substance in it. Then there were also clarifications by Adani after the allegation that had been made against Adani. Now, earlier in January 2023, when the report against Adani had been published, then the prices of the shares of Adani Group of companies came down substantially. And there was a huge loss. There was a huge loss to the shares of the Adani Group of companies. And the loss in market capitalization, it was greater than $100 billion. And recently in 2024, when the second report of Hidenburg was published, in which the allegations of conflict of interest involving the Sebi chairperson Madhabi Buch and her husband were made, then again the shares of Adani Group of companies came down. But this time since they were only allegations, so the loss was not that much. This time, out of 10 companies in the Adani group, the shares of 8 companies, the stocks of 8 companies, they came down, and there was a loss of nearly $13 billion. So the loss was less this time, because this time the public understood that these are merely allegations, but there was the fall in price of shares this time also. Now, the allegations made by Hidenburg in this second report, one was regarding the conflict of interest. Allegations were regarding the conflict of interest involving the chairperson of Sebi, Madhavi Buch, and her husband. Now, Madhavi Buch, she was earlier a member of Sebi till 2022, and later she became, till 2022 she was a member, and later she became the chairman of Sebi. And first allegation was that Madhavi Buch and her husband had invested in the same fund in which the brother of Gautam Adani had invested, and which had been set up by one of the former directors of the Adani group of companies. And the second allegation made by Hidenburg was that Madhavi Buch's husband, the husband of Madhavi Buch was appointed senior advisor by a foreign company named Blackstone. And Madhavi Buch, the chairperson of Sebi, she started promoting a product called Real Estate Investment Trust. Now, real estate investment trusts, they are like mutual funds. They are like mutual funds for real estate. So just as mutual funds, they take money from the investors invest their money in mutual funds, and the mutual funds, they invest this money in different companies or different businesses, in the shares of different companies or businesses, and the profits are distributed among the investors. So what happens in case of real estate investment trust is that the investors, people are investing their money in these real estate investment trusts, and these trusts, they are investing in housing projects. They are investing in real estate, and whenever the price of real estate it goes up, when profits are made, then these profits are distributed among the investors. So these are real estate investment trusts. Now, what the allegation was, that chairperson of Sebi, that is Madhavi Buch, she started promoting this real estate investment trust. And after she started promoting this real estate investment trust, after that, this company Blackstone, the foreign company in which her husband was senior advisor, this company introduced 2 real estate investment trusts for which IPOs were conducted in case of India. So for these 2 real estate investment trusts introduced by Blackstone, initial public offerings, they were conducted in India. IPO means issuing the shares for the public for the first time. So the IPOs for these 2 real estate investment trusts introduced by Blackstone, they were conducted in India after the chairperson of Sebi started promoting them. So as we can see, there is a clear conflict of interest. Now the question is whether this conflict of interest was disclosed or not. Now if such a conflict of interest is not disclosed, then it is going to harm the retail investors. Because if the disclosure is not done on time and it is done later, then the market might take a hit and it may adversely affect the retail investors. Now we are going to study what are the questions raised on the functioning of Sebi. Now the questions are, the first question: if the chairman of Sebi had disclosed the information earlier regarding her investments in the foreign fund in which the brother of Gautam Adani had also invested, did she disclose the information earlier? When initially the Hidenburg report had been published in January 2023, did Madhavi Buch disclose this information? And if she disclosed this information, if she knew about all this, why did she not recuse herself from the beginning? She has actually overseen the investigations into the Adani group of companies. And as we can see that she had also invested in one of the foreign funds in which the brother of Gautam Adani had invested, and this fund was set up by a former director of Adani group of companies, and this fund was also being investigated by Sebi. and she was overseeing the investigations. So there was a clear conflict of interest. Why did she not recuse herself from the investigation? She should have recused herself. She did not recuse herself. So this is a big question. Then a petition had been filed in the Supreme Court and regarding this case, and when this petition was filed in the Supreme Court to conduct investigations into the Adani group of companies, into the allegations by Hidenburg, into the Adani group of information, why was this into the allegations by Hidenburg against the Adani group of companies? Then why was the information that the chairperson of Sebi, that is Madhavi Buch, she had invested in the same fund in which brother of Gautam Adani had also invested? Why was this information not disclosed? Why was it not disclosed to the Supreme Court? And also, there is a board of Sebi. There is a board of Sebi consisting of chairperson and 8 members. Did this board know about all this? Did this board know that there is a conflict of interest regarding the Sebi chairperson? Did the Supreme Court know about it? Just for information, the board of Sebi, it has got the chairperson and 8 members. Chairperson and 8 members, and out of these members, 2 members, they belong to ministries of the central government which deal with finance and administration. So ministries of central government which deal with finance and administration, 2 members are from these ministries. 1 member is from the RBI and 5 other members are appointed by the central government. And out of these 5 members, 3 will be whole-time members. So this is in brief the composition of the Sebi board. And this Sebi board is established under Section 4 of the Sebi Act 1992. Now we come back to the questions raised. Then was the information regarding the conflict of interest involving the Sebi chairperson, was it disclosed to the finance ministry? Was it disclosed to the RBI governor? Another question. Then why was the government not proactive when the Adani issue was raised in 2023? If the government knew about this conflict of interest, why did it not change the Sebi chairperson? Why did we have to wait for the second report of Hidenburg to come for this controversy to further intensify? So these are the questions raised. Then Supreme Court had also set up a 6-member committee in March 2023 to look into the investigations by Sebi. So this committee had been set up to look into the investigations by Sebi and to report to the Supreme Court. Was this 6-member committee informed regarding the conflict of interest involving the Sebi chairperson? Was it informed about this fund in Mauritius in which the Sebi chairperson and her husband had invested? And if this committee was informed, did this committee inform the Supreme Court? So all these are questions raised. Then this we have already seen. Under Article 32 and 142 of Indian Constitution, it is said that if there are certain circumstances where there is a conflict of interest, where the people who are overseeing the investigation, if there is a conflict of interest involving these people, like in our case, it is in the present case, it is the Sebi chairperson. If there is a conflict of interest, then the Supreme Court can form a special investigation team. Supreme Court can also order the CBI to conduct investigations. But the Supreme Court did not order the CBI to conduct investigations. Supreme Court did not form such a special investigation team. Supreme Court said that this can be done only in exceptional circumstances. But then, are these circumstances not exceptional? When we know that there is a conflict of interest regarding the Sebi chairperson, these of course are exceptional circumstances, and the special investigation team should have been set up. But the Supreme Court did not set up the team. So again, this is a big question. Now we come to the issues involving Sebi. First, we will study in brief about when the Sebi was set up. Now, earlier there was an authority set up under the Capital Controls Act. This was before 1988. Then Sebi was established through an executive order in 1988. Then it was only established through an executive order, then it was not a statutory body. And the Sebi Act, it was passed in 1992 and Sebi became a statutory body in 1992. And we have already seen that Sebi board established under section 4 of the Sebi Act 1992. We have studied the composition of the board. At present, the two Government of India representatives in Sebi, they are Mr. Ajay Seth, Secretary Department of Economic Affairs, Ministry of Finance, and Mr. Manoj Govil, Secretary Ministry of Corporate Affairs. And the representative from RBI is Mr. Rajeshwar Rao, who is the Deputy Governor of RBI. Now, what are the problems with Sebi? What are the issues with Sebi? Before studying the issues with Sebi, we will first see what are the functions of Sebi. Functions of Sebi involve, first is investor education and protection and raising awareness among investors. So, as we can see, certain campaigns like mutual fund sahi hai. This campaign is being run by Sebi. So, this is for investor awareness. Then Sebi also is involved in grievance redressal for investors. Scores is a platform set up by Sebi for investor grievance redressal. Then protection of market intermediaries. Regulation of market intermediaries, it is also a major function of Sebi. Now market intermediaries, they involve brokers, they involve depository participants, they involve mutual fund companies, portfolio managers, etc. So these are the market intermediaries. There is an investor, then there is a security market, stock market. So between the investor and the security market, market intermediaries like the brokers, the mutual fund companies, the portfolio managers, and the depository participants, they act as a link. And regulation and registration of these market intermediaries, regulation and registration of market intermediaries is a function of Sebi. Now, other functions of Sebi involve market surveillance and monitoring of the market. So, surveillance of the market and monitoring of the market is a major function of Sebi. Then, preventing insider trading. This is also a major function of Sebi. Prevention of insider trading. Now, what is insider trading? Insider trading means buying or selling of securities based on confidential information that is not yet known to the public. Now, suppose there is an organization, there is a company, and there is a member, an employee of this company. Now, this employee of this company has got access to certain confidential information that is not available with the public. Now, if this employee of the company misuses this confidential information to buy and sell securities, and profits from buying and selling of securities by means of this confidential information, by misusing this confidential information, since this confidential information is known only to this person, to this employee, it is not known to the public. Suppose the employee knows that the prices of shares are going to go up. So the employee purchases the shares knowing that at a particular time when the prices of shares are going to go up. Now this confidential information is available only with this employee of this organization. This is not available to the public. So this employee in a way has misused his or her position within the organization for profiting from buying and selling of securities. So this is known as insider trading. So Sebi prohibits insider trading. Sebi takes actions to prevent insider trading. Now, what are the issues with Sebi? What are the problems with Sebi? The first issue is weak enforcement of corporate governance norms. Now, weak enforcement of corporate governance norms. This was seen in the recent crisis involving Zeal, that is Zee Enterprises Entertainment Limited, and also in the Yes Bank crisis. Now, what was this Zeal crisis? So, in this case, 200 crores worth of FDs, that is fixed deposits, available with Yes Bank. 200 crore worth of fixed deposits belonging to Zeal that were available with the Yes Bank was used to adjust the loans of 7 associate entities of Zeal. Actually, what happened was that the managing director of this Zeal company, the managing director and CEO, that is Mr. Puneet Goenka, and also the chairman emeritus of Zeal, that is Mr. Subhash Chandra. There were allegations against them of diverting the company's fund and engaging in undisclosed related party transactions. So there were allegations that they were diverting the company's funds. And the fixed deposits of Zeal that were available with Yes Bank, they were diverted to adjust the loans of 7 associated entities of Zeal. So this diversion of funds, it was an example of corporate governance failure, and the independent directors of Zeal, they had raised concerns about this. So this was a case of corporate governance failure, and Sebi was conducting investigations into it, and Sebi, as we can see that since this corporate governance failure occurred, it shows that Sebi was weak in enforcing the corporate governance norms in Zeal. And because of this crisis, there was earlier going to be a merger between Zeal and Sony company. So this merger was put off because of this corporate governance failure. So this was one of the issues, one of the problems that had occurred with the regulatory effectiveness of Sebi. Then Sebi, as we have just seen, that Sebi takes measures to prohibit insider trading. And what is insider trading? It is the buying and selling of securities by using the confidential information which is not available to the public. So buying and selling of securities based on confidential information that is not yet available to the public, that is insider trading. So there were allegations of insider trading in the Religare enterprises, and Sebi's response to these allegations of insider trading and fund misappropriation in the Religare enterprises, Sebi's response was again a delayed response. So this was again one of the issues that occurred with the problems with regulatory effectiveness of Sebi. Then about the IL&FS crisis. Now IL&FS is a company which invested in the infrastructure projects. It was investing in the infrastructure projects, and IL&FS, it got involved in certain public-private partnerships with the Government of India. Now, Government of India had introduced the new Land Acquisition Act, and this company, IL&FS, was required to pay compensation to people after acquiring land, and this compensation was huge. It was required to pay a large amount of compensation. Then there were delays in land acquisition. There were delays in regulatory clearances from the government side. There were delays in regulatory clearances from the government side. So all this happened. And because of these delays, it affected the infrastructure projects. The infrastructure projects, they could not start on time. So then, because of this, the infrastructure projects, they did not start on time, and this caused losses to the IL&FS company. Now, this ILNFS company, what it was doing was that it was taking loans. It was taking loans from banks for 8 to 10 year period, and it was investing in infrastructure projects which had a duration of nearly 15 years. And after 8 to 10 years, it was getting the loans refinanced from the banks. When the bank started seeing that ILNFS is actually incurring a lot of losses, then the banks stopped refinancing the loans of this ILNFS company. And now the bank stopped refinancing. So ILNFS had already invested in the infrastructure projects. It needed money. So it started borrowing from the money market. And the money market, we know that when we borrow from money market, the repayment is to be made within a 1 year period, within 1 year or less than 1 year period. So the repayment was to be made in 1 year or less than 1 year. But the money from the infrastructure projects would come after a 15-year period. So ILNFS could not repay the loans. And when it could not repay the loans, it started going into crisis. And it became bankrupt. So this was the ILNFS crisis. Now Sebi was required to investigate into this crisis, and Sebi was delayed in its investigations into the ILNFS crisis. Then the next issue with Sebi was regarding conflict of interest. Now we have already seen in case of the Sebi Hidenburg controversy, Adani Hidenburg controversy, that in this Sebi, there was a conflict of interest regarding the Sebi chairperson Madhabi Buch and her husband. This we have studied in detail. Then about the NSE co-location scam. Now what is NSE? NSE is the National Stock Exchange, in which the trading of shares takes place. Now what was this scam? First we'll study what is the co-location facility. The co-location is a data center or a telecom facility in which a business can rent the space. It can rent the space for servers, for storage devices, and for other computing and networking hardware. So businesses can rent space for servers, for storage devices, and for computing and networking hardware. So this is a co-location facility. So NSE was providing such co-location facility to the businesses. Now what happened in this NSE co-location scam was that there were allegations that preferential market access was given to certain brokers in these co-location facilities that resulted in market manipulation and artificial information asymmetry. So preferential access was given to certain brokers. Now actually what happened was in this co-location facility, the market participants who were using the businesses or the market participants that were using these facilities, they could have faster access to the stock prices. They could know about the stock prices that were being broadcast by this National Stock Exchange. That is, they could have access to the stock prices that were being broadcast by the NSE. And when they get access to the stock prices, it resulted in faster execution of their trades. So this was a benefit of these co-location facilities. Now the allegation was that certain traders, they were given preferential access. That is, they got access before other traders. So the staff of NSE was also involved. There were allegations against the chairman of NSE, that is Chitra Ramakrishna, and several other employees in NSE also. So it was alleged that the staff of NSE was involved in giving preferential access to certain brokers. that is giving access to these brokers before others got access. So even a few seconds of faster access can lead to huge profits. So this preferential access was given in the co-location facility, and this was the NSE co-location scam, and these brokers, they made huge profits. And since the chairman of NSE, there were allegations against chairman of NSE, Chitra Ramakrishna, and the other staff of NSE that they were involved, they were hand in glove. A business known as OPG Securities, it was OPG Group was involved in this group. It was alleged that this group was given preferential access in the co-location facility, and it made huge profits. And it was alleged that the staff of NSE, they were also involved in this. They connived with this OPG group, and they provided faster access to them, and this led to huge profits for this OPG group and losses to others. So this was the NSE co-location scam, and in this also conflict of interest was involved. Now we have studied the issues with Sebi. Next we are going to study what are the suggestions to improve the functioning of Sebi. What should be done to improve the functioning of Sebi? First is that there should be stronger corporate governance. Sebi should regularly audit the company's governance practices so that the problems can be caught early, and swift action should be ensured. This is the first suggestion. So regular audit of the company's governance practices. Then the next suggestion is there should be advanced tools to monitor trading in real time. So there should be advanced technology and tools to monitor trading in real time so that there is better market monitoring. And practices like insider trading can be prevented. Also, Sebi is conducting, we have seen certain cases in which Sebi has conducted delayed investigations. In this NSE scam also, Sebi investigation was delayed. Sebi had conducted investigation and had passed an order asking for imposing a huge penalty on the chairperson of National Stock Exchange, that is Chitra Ramakrishna, and several others. But then the Security Appellate Tribunal, that is the appellate body of Sebi, it had overturned the Sebi order, because when Sebi conducted investigations, it actually gave the task of conducting investigation to the NSE itself. So it was like the NSE conducting an investigation against itself. So Sebi was not sincere in its investigation. So it entrusted the task of conducting investigations against the National Stock Exchange to members of the NSE itself. So the Security Appellate Tribunal, it overturned the order of Sebi. So in this case, we can see that it was not a sincere attempt, not a sincere investigation by Sebi, and also there were delays. So such delays should be prevented. And in IL&FS case also there were delays by Sebi. So how can the delay be prevented? The delay can be prevented by having strict timelines. Then there should be increased transparency. The key decisions of Sebi, they should be shared publicly. This is done in case of the European regulators. In European regulators, the decisions, they are shared publicly. So in India also we should adopt this practice. Now we come to the role of regulatory bodies. What is the role of regulatory bodies? Now regulatory bodies, before 1991, government had a strict control over the Indian economy. And private sector activities, they were regulated by means of licensing and quota. So there were strict regulations, and state was maintaining the dominant control. But after 1991, there was economic liberalization. And after the liberalization, sectoral governance, it was handed over to the regulatory bodies. And private firms, they were allowed in sectors that were previously dominated by the government. Sectors like electricity and telecom, which were previously regulated by the government, the private firms were also allowed here. And now the role of regulatory bodies, it became all the more important, and regulatory bodies were necessary to ensure fairness between the public and the private players, between the public and the private companies, and for protecting the consumer interest, encouraging innovation, and keeping our economy, keeping the growth of our economy stable. The regulatory bodies, they became all the more important. Now, regulators incentivized private investments by giving them functional autonomy and shielding them from government interference. Now, when the regulator is empowered, then there are good results. But when the regulator is not empowered, when the regulator is conducting improper regulations, then the results are not favorable. Now we will see certain examples of how an empowered regulator led to fruitful results and how improper regulations led to problems. Now, example of an empowered regulator is the RBI in case of the NPA crisis. So RBI by taking effective measures like the prompt corrective action framework and the asset quality review and the insolvency and bankruptcy code, RBI was successful in containing the NPA crisis. Now, what was this prompt corrective action framework? It was an early intervention mechanism for banks which had become undercapitalized because of poor asset quality and which had become vulnerable because of loss of their profitability. Now, the NPAs in the banking sector, they were growing. And what the RBI did was that RBI designated certain risk thresholds in certain areas. It started monitoring certain areas like capital asset like the asset quality, like the capital to risk weighted asset ratio, like CRAR, that is capital to risk weighted asset ratio, the NPA ratio, the tier 1 leverage ratio. So there were certain areas which RBI designated and it started monitoring these areas. And if any bank was breaching this risk threshold, then certain restrictions were imposed on the bank. Restrictions like a stressed bank not being allowed to expand credit or investment portfolios. So these kind of restrictions were placed in order as a form of corrective action. So this was the prompt corrective action framework. So it was a kind of early intervention mechanism for banks that were having this NPA crisis, and certain areas were monitored, and if the bank was performing poorly, if it was breaching the risk threshold, then certain restrictions were imposed on the banks. This was the prompt corrective action framework. Then another was the asset quality review. This was an exercise done by the RBI to assess the level of NPAs in the banks, the level of bad loans or NPAs in the banks. And the third was the famous insolvency and bankruptcy code. So it gave a faster insolvency resolution process and helped creditors recover their money faster. So this was the insolvency and bankruptcy code of 2016. So RBI's action in containing the NPA crisis, it is an example of how an empowered regulator can give fruitful results. Then another example of an empowered regulator giving fruitful results is the actions by the Security Exchange Board of India, that is Sebi, after the global financial crisis and the Satyam fiasco. Now, the actions by the Sebi after the global financial crisis. Now we know that what was the global financial crisis? We know that it occurred in the year 2008 and it was triggered by the first bank that collapsed was the Lehman Brothers in the USA. What had happened was that certain the people, this crisis, this global meltdown, the financial crisis of 2008, it has been triggered because of giving loan to the subprime investors, the subprime customers, because these people, they were not capable of repaying the loans, and loans were given to them, and because of this, the financial crisis had been triggered. Actually, what had happened was that there was an act in USA which had actually removed the distinctions between the investment banks, the insurance companies, and the commercial banks. And the Federal Reserve of USA, the Federal Reserve, had lowered the interest rates. Now, earlier, the prime lender, the prime customers, they were taking loans from the commercial banks for purchasing houses. They were taking loans from the commercial banks for purchasing houses. And now, since the act, there was the removal of, after the removal of distinction between investment banks, insurance banks, and commercial banks by an act called the Glenn-Steagall Act in USA, the commercial banks also started performing the functions of the investment banks. The commercial banks used to give loans to these prime customers by means, brokers used to act as intermediaries in between. The loans were given to these prime customers, and these prime customers used to give their mortgage papers in return. The mortgage papers were given in return to these commercial banks as securities. And these mortgage papers, they were made into CDOs, collateral date obligations. They were in the form of these mortgage papers in the form of collateral date obligations. They were used by the investment banks. Now, what the investment banks did was they issued certain collateral date obligation. They took these mortgage papers, they converted them into collateral date obligations, and they sold them to investors. Now, these were securities. Since the value of these collateral date obligations, it was linked to the price of the houses. So when the price of the houses would go up, the value of these securities would also go up, and investors would profit. And these securities, they were insured by means of CDS, that is correct. They were like insurance. They were insured by certain insurance firms in the form of CDS, collateral date securities. And since they were insured, the investors purchased them. And when the Federal Reserve had lowered the interest rates, more money came into the market, and there was more purchase of these CDOs, collateral date obligations. Now, pressure started mounting. Other investors, that is the large number of investors, they started, when the prices of these houses were going up, they thought that these securities were profitable, these CDOs were profitable, and they were also insured. So they started purchasing more and more of these CDOs. When they started purchasing more, there became a scarcity of these CDOs, and they started demanding more CDOs. So when they started demanding more, there was a pressure on these commercial banks, there was a pressure on these investment banks to give more CDOs to these investors. So the investment bank told the commercial banks, please give us more mortgage papers. So the commercial banks told the broker, please bring more customers. Now the prime customers were limited, and now there were no more prime customers available. So the broker started looking for other customers to give loans. So they got hold of the subprime customers. They told the subprime customers, please take loan, we will give you loan. And now they started searching for subprime customers. Now these subprime customers, they were not capable of repaying the money. So the brokers started, but the brokers were forcing them, please take the loan, and we will give you loan. Don't worry, we will give you loan. Even though these subprime customers did not have the capacity to repay. And the mortgage papers that these people gave, that these subprime customers gave, they were often sometimes even fake mortgage papers were given. And this and on the basis of these mortgage papers, we know that the CDO, the collateral debt obligations, are prepared, and these CDOs are purchased by investors, and investors purchase them. But now these CDOs, they are backed by mortgage papers of these subprime customers, and these subprime customers sometimes give fake mortgage papers. And now the investors are still thinking that they are making profitable investments. But now what happened was that these subprime customers, they were not able to repay their loans. And it was found that the brokers are desperately searching for subprime customers who don't have the capacity to repay. And many of these securities, these mortgage papers, are fake. So then the bubble started bursting. The market started going down. There was panic. The investors' money started going down. And people started panicking. They started selling their collateral debt obligations. Because these people, they did not have the capacity to repay. That means these CDOs, which had been insured by companies, they are of no value. So the market started going down. Because when these people, they are not able to repay these loans, not these prime people, but the subprime people. Prime customers are over. Subprime customers are not able to repay their loans. Now what will the commercial bank do? Commercial bank will actually confiscate their houses, because they are not able to repay their loan. They have given the mortgage papers for their houses. So the commercial bank will confiscate their houses when they are not able to repay their loans. Now houses are getting confiscated. So there will be obviously the prices of houses will start going down. Price of houses is going to go down, because there will be, when banks are confiscating more number of houses, so then there will be more supply of houses. So the price of house will start going down. Large number of unoccupied houses will now be available in the market, because they have been confiscated by the banks, and banks want to sell them to others, sell them to customers in order to recover the money. Now the price of houses starts going down. Now what happens is, when the price of houses starts going down, then these prime customers who had taken loans for purchasing houses, the price of their house will also start going down. When the price of their house will start going down, they also will start panicking. They also stop repaying the loans. They also start selling their houses, and they stop repaying the loans. When they stop repaying the loans, again the value of these CDOs goes down. The investors start panicking, and the bubbles bursts further. So in this way, the entire economy, it crashed. So this was the great global financial crisis of 2008. Now India was very little impacted by it, because India was less impacted, but still there was an impact on India. Indians had made investment in one of the companies. ICICI Bank had made investment in Iceland, and Iceland had huge investments in these collateral debt obligations. So Indian companies did suffer to some extent. ICICI suffered, but not to a great extent. But there was some impact. Now Sebi steps after the global financial crisis, they were very effective steps, and it led to fruitful results. What were these steps? Sebi, after the global financial crisis, it liberalized the takeover code. It liberalized the takeover code. Now takeover code means that when one company is being taken over by another company, then there is a mandatory rule that shares have to be issued in a fresh manner to the public, so that the public has the option to decide whether they want to stay with the new company or they want to withdraw their investment. So this was the takeover code. So Sebi had liberalized the takeover code after the global financial crisis. Sebi had also increased the volatility margins, and it had also increased the extent of disclosures that were to be made by the company. So these were certain steps which were taken by Sebi after the global financial crisis. Then about the Satyam fiasco. So Sebi had also taken certain effective steps after the Satyam fiasco. Now, what was this Satyam case? In Satyam case, the accused in the Satyam case, they were found guilty of bogus inflation of the company's revenue. So, company's revenue were inflated in an illegal and bogus manner by those who were managing the Satyam group of companies. So, bogus inflation of the company's revenues, falsifying of the company's accounts. The accounts of the company, they were falsified. The IT returns were falsified. And invoices of transactions, they were fabricated. So this is what happened in the Satyam scam. And after the Satyam scam, Sebi took certain effective steps like appointing a new board of directors. So Sebi appointed a new board of directors. Then another step that it took was it relaxed the takeover norms. It relaxed the takeover norms. And a company called as Tech Mahindra, it took over the Satyam company. So Sebi approved that Satyam Services would choose a strategic investor in the form of which could acquire 51% stake in the Satyam company through a global competitive bid process, and because of this, the Satyam Computer Services, it was acquired by Tech Mahindra. So these were certain steps taken by Sebi after the Satyam crisis, and these steps were effective steps. Now we have just seen examples of effective regulations by regulatory bodies. Now we will study certain examples of improper regulations and how these improper regulations have led to losses. So one example of improper regulation is the AGR issue, that is the adjusted gross revenue issue. What happened was that the Supreme Court, it ordered in October 2019, the Supreme Court ordered that telecom companies were required to pay 1.47 lakh crore rupees as adjusted gross revenue. 1.47 lakh crore rupees were required to be paid as adjusted gross revenues to the central government. Now, what is this adjusted gross revenue? This adjusted gross revenue, it involves, it says that telecom, it involves the licensing fee, the license fee, and the spectrum usage charges, which are required to be paid to the central government in the form of revenue share. Now, earlier, after the 1994 telecom policy, the telecom sector had been liberalized. And after liberalization of the telecom sector, a rule was introduced according to which licenses were issued to the telecom companies in return for a fixed license fee. So earlier there was a fixed license fee, and in return for that, licenses were issued. But this was changed in 1999, and after 1999, a new rule was made that now the telecom operators, they were required to share a percentage of their adjusted gross revenue with the government as annual license fee and spectrum usage charges. Now this definition of adjusted gross revenue, it has been in litigation for about 14 years. So in litigation for about 14 years. Now what happened was in 2005, in 2005, Cellular Operators Association of India, it challenged the definition of AGR. It challenged the government definition of adjusted gross revenue calculation. Now, what the Department of Telecom says is that adjusted gross revenue should include the revenue from both the telecom services as well as the non-telecom services. This is the government stand. And what the companies say, what the telecom companies say is that it should include only the telecom services and not the non-telecom services. Not the non-telecom services like dividend, like the interest income, or the profit on the sale of investment, sale of assets. So these things should not be included. So government says that only the revenue from the companies say that only the revenue from the core services, that is the telecom services, should be included in the form of AGR and not the revenue from the non-core services. But the government says that both of these should be included in the form of AGR. So in simple words, the government is demanding more money from telecom companies, but the companies are willing to pay less money in the form of adjusted gross revenue. Now, in 2005, as we have seen, this company, Cellular Operators Association of India, challenged the government definition of AGR, and the TDSAT, the Telecom Dispute Appellate Tribunal, it ruled in favor of the telecom companies. It said that the AGR should include only the revenue from the telecom services, that is the core services, and not the revenue from the non-telecom services. But this order of this TDSAT in 2015, TDSAT had given this order. This was overturned by the Supreme Court recently in October 2019. So what did the Supreme Court say? It said no, the government definition is right. It said the government definition is right. That is that AGR, the adjusted gross revenue, it should include the revenue from both the telecom services as well as the non-telecom services like dividend, profits, sale of assets, deposit interest, etc. So this was the AGR issue, and the court has ordered the telecom companies to pay revenues of about 1.47 lakh crore to the central government. Now the companies will face difficulty in paying this revenue. The companies are going to face difficulty because there is severe competition in the telecom sector, and because of this severe competition, the telecom companies, they charge less average revenue per user. And now government is demanding so much of dues, so the telecom companies are definitely going to be stressed. So this is a kind of crisis for the telecom companies. This crisis would not have arisen if the government had provided an enabling environment, if the TRAI was more effective in regulation, then such a crisis would not have arisen. So this AGR issue, in which the telecom companies were under stress because of the Supreme Court order, this issue is an example of improper regulation by the regulator, that is the Telecom Regulatory Authority of India. Now we come to what are the issues with the regulatory bodies in India. What are the issues with the regulatory bodies in India? Now the main issues with regulatory bodies, the first issue is the populist pressure. So there is a government interference with the functioning of regulatory bodies. It is a major issue with the regulatory bodies. Then other issues involving regulatory bodies are selection of non-experts. Now non-experts, when you select non-experts to head the regulatory bodies, then it creates problems. Now, example of selection of non-experts is when a former finance secretary was appointed the RBI chairperson. Now, finance secretary being appointed as RBI chairperson, the fine secretary may not have the relevant expertise, because the RBI chairperson needs to be well versed in the matters of finance, but finance secretary is usually a former bureaucrat, and this person may not be that expert in regulating the matters in RBI. So this is an example of selection of non-experts. Then there is the inefficient review mechanism. At present, the review is by means of parliamentary committees, and this review mechanism is not very robust. Then the next issue is that the recommendations that are made by the regulatory bodies, they are rarely implemented. Government often does not implement them. Then overlapping of powers. Administrative incoherence and overlapping of powers and jurisdictions and unclear guidelines is a major issue with regulatory bodies. Example is when there are overlapping jurisdiction, example can be the CPCB, that is the Central Pollution Control Board, and the National Green Tribunal. Their jurisdictions are overlapping. Another example of overlapping jurisdictions may be All India Council of Technical Education and UGC in the field of education, higher education. Another example is the controversy between Sebi and the IRDAI, that is the Insurance Regulatory Development Authority of India, with regard to the unit-linked insurance plans, unit-linked insurance policy. So both of these regulators, they started interfering in each other's work. Sebi said it is my jurisdiction to regulate ULIPs, and IRDAI said no, I am concerned with the insurance sector, so I will look into this issue. Then next problem is structural weaknesses. So the posts of many experts posts are vacant, and this promotes inefficiency in the regulatory bodies. So structural weakness is a major issue with the regulatory bodies in India. Now at present, in the CPCB, that is the Central Pollution Control Board, nearly 20% of posts they were said to be vacant. So this is an example of structural weakness. Then there is the problem of fragmented control. Fragmented control is again like overlapping jurisdiction. Multiple regulators, they are overseeing the same sector. Example, Telecom Regulatory Authority of India and Department of Telecom, overlapping jurisdiction. And we have already seen this in the previous point, that is overlapping jurisdictions, administrative incoherence and overlapping jurisdictions. So these 2 points are really the same. So overlapping jurisdiction, that is All India Council of Technical Education and UGC, overlapping jurisdiction. Sebi and IRDAI, they had a conflict with regard to regulating the unit-linked insurance plans. Example of overlapping jurisdiction, the Central Pollution Control Board and National Green Tribunal. Example of overlapping jurisdiction. DRI and Department of Telecom, again overlapping jurisdiction. So this is a major issue with the regulatory bodies. Then the problem of outdated legal framework. So the regulators, they are operating under outdated laws, and we need to update these laws, because if they operate with outdated laws, then they won't be able to function effectively. So these are certain issues with the regulatory bodies in India. Then there are certain other problems also, like at present, the appointments in regulatory bodies, mostly it is treated, the post in the regulatory bodies, it is treated as post-retirement perquisite given to bureaucrats, that is IS officers. After they retire, they are often made chairperson of these regulatory bodies. They are appointed members of these regulatory bodies on the basis of how they had functioned when in service. So this is an issue. Then the tenure, appointment and removal process. There is lack of uniformity. Now at present, the appointment and removal, it is with the central government. In case of Sebi and IRDA, in case of Sebi and IRDA, Insurance Regulatory Development Authority, the appointment, the power of appointment and the power of removal and appointment is with the union government. It is completely with the union government. And the power of removal in case of the Central Electricity Regulatory Commission, the power of removal is on reference of the union government. The Supreme Court conducts an inquiry and thereafter the members of chair or chairperson are removed. So in case of members of Central Electricity Regulatory Commission, how are they removed? First, the union government will make a reference and then Supreme Court will conduct an inquiry and after that they will be removed. So this is the process. So union government, as we can see, it has got a lot of power. So union government having a lot of power with respect to the appointment as well as the removal process, this is a danger signal because this will mean interference by the central government in the functioning of these regulatory bodies. So we have just seen that the power of removing the members and chairperson of Sebi as well as those of Insurance Regulatory Development Authority, it is with the union government. And in case of Central Electricity Regulatory Commission, on reference by union government, Supreme Court conducts inquiry and then the members are removed. So excessive powers with the central government means lack of autonomy for the regulatory bodies. Now we come to certain suggestions for the regulatory bodies. What should be done to improve the functioning of these regulatory bodies? So first suggestion is that there should be self-evaluation. Self-evaluation, the regulatory bodies should be encouraged to conduct a self-evaluation of themselves once in a few years, suppose 3 years. So self-evaluation once in a few years should be done by the regulatory bodies themselves and the conclusions they should be put in the public domain so that the public can take informed decisions. There can be informed discussion and debate. So there should be self-evaluation of these regulatory bodies once in a few years. Then financial autonomy to regulatory bodies is very important. Financial autonomy is very important because they can have functional autonomy only if there is financial autonomy. Because at present, many regulatory organizations, they are dependent on the government departments for budget allotment. They are dependent on these government departments for financial support. So there is a very dire need for financial autonomy of these regulatory bodies. Then promoting accountability of these regulatory bodies. This is very important. Because if you give functional autonomy, but if you don't have accountability, then again it is going to lead to disaster. So we need accountability. There should be accountability for these regulatory bodies. Then the system of appointment of these regulatory bodies, it should be transparent. System of appointment should be transparent. Then the next point is there should be regulatory impact assessment. What is regulatory impact assessment? Regulatory impact assessment is a kind of cost-benefit analysis. It is a kind of cost-benefit analysis of the impact of regulatory bodies. This is called as regulatory impact assessment. So it means critically assessing the positive effects and the negative effect of the proposed regulations and the existing regulations. So this is called the regulatory impact assessment, assessing the positive effects and the negative effects of the proposed and existing regulatory as well as non-regulatory alternatives. So this is regulatory. Suppose there is a regulator. So what are the positive impacts of having these regulators? What would have been an impact if there was no regulator? So this kind of assessments, cost benefit analysis, this is called as regulatory impact assessment. There should be periodic regulatory impact assessment. Now we come to certain reports. The 12th report of the second ARC, Second Administrative Reforms Commission, what did it say in its 12th report regarding the regulatory bodies? Now, what does second ARC says is we should review and repeal the unnecessary laws. We should review and repeal the unnecessary laws, and we should update the outdated procedures. Second thing, there should be strong internal supervision of regulatory agencies. Strong internal supervision, and there should be periodic assessments so that high standards of enforcement can be maintained. Then there should be self-regulation, self-evaluation of regulatory bodies once in few years, and self-regulation in fields like taxation and public health. There should be self-regulation. And if this voluntary compliance or self-regulation is there, then it will reduce the burden on the enforcement agencies. Then the regulatory procedures, they should be made simple, transparent, they should be made citizen friendly, and we should incorporate information technology. We should reduce discretion and promote transparency, and also we should minimize corruption. This is what was said by the Second Administrative Reforms Commission, the 12th report. Now, what did the second ARC say in its 13th report? It said that we should involve the citizens groups as well as professional organizations in regulatory activities. So there should be participation from all stakeholders. And these citizen groups and professional organizations, they should share the burden of enforcement, they should certify compliance. Then the parliamentary oversight by means of these department-related standing committees, it should be strengthened. Then each ministry should publish a management statement. Each ministry should create a management statement that is outlining the roles of the regulator, that is outlining the roles and objectives of the regulator. And also there should be uniformity in the appointment, tenure and removal of regulatory authorities. There should be uniformity. At present, there is lack of uniformity. We can have a uniform tenure like 5 years or 65 years of age, whichever is less. This kind of rule can be made. There should be uniformity. So these are certain suggestions to improve the functioning of regulatory bodies. Now we come to the questions relating to what we have studied. Now, first question is, what are the problems affecting the regulatory institutions in India? Elaborate on the problems affecting the regulatory institutions in India, along with suggestions to improve their functioning. The problems affecting the regulatory institutions in India, along with the suggestions to improve their functioning. Now in this, we can discuss, we have already studied the problems affecting the regulatory institutions in India. What are these problems? One is overlapping jurisdictions. We have studied this. Overlapping of jurisdictions of regulatory bodies. Then selection of non-experts, like selection of a finance secretary to head the RBI. Then inefficient review mechanism by means of the parliamentary standing committees. This is also a problem. Then recommendations made by regulatory authorities are rarely implemented. There are a plethora of laws governing many regulatory agencies. There is variation in the appointment, tenure, and removal of regulatory authorities. There is overlapping of jurisdictions and unclear guidelines. There is fragmented control like TRI and Department of Telecom, like Sebi and IRDA. The TRI and Department of Telecom. Then there is All India Council of Technical Education and UGC, overlapping jurisdictions, CPCB, Central Pollution Control Board, and NGT. Again, overlapping jurisdictions. Now, this don't take Sebi and IRDA in this. This is regarding the appointment and removal process. In Sebi and IRDA, the removal of the members is by the central government. In Central Electricity Reforms Commission, Regulation Commission, on reference of Union Government, investigation is conducted by Supreme Court and then the removal is done. So, too much power with central government is going to adversely affect autonomy of the regulatory bodies. Then budgetary powers. The budget of these regulatory bodies is controlled by the central government, by the government departments it is controlled. So this is adversely affecting the autonomy of these bodies. And also there is a need for these regulatory bodies to report to the union government for budgetary allotments, for endorsement of appointment of their staff. So too much power is there with the central government. And this is adversely affecting the autonomy of these regulatory bodies. Then what are the other issues? Other issues involve, we have already studied the selection of non-experts to head regulatory bodies, lack of financial autonomy with regulatory bodies. These are the issues. Then what are the suggestions for improving the functioning of these regulatory bodies? We can write all these suggestions like self-evaluation, financial autonomy, then transparency in appointment, regulatory impact assessments, then repealing the unnecessary laws, reviewing and repealing unnecessary laws, internal supervision, self-regulation, reforming of regulatory procedures, etc. So in this way, we can write, and we can also write about the need for a management statement which needs to be published by each ministry, outlining the roles of the regulator. And based on these guidelines, the government, in consultation with the parliamentary committees, it can fix the principles on which regulators need to be evaluated. So, first there should be a body of experts, to propose guidelines for working of regulatory bodies, for periodic evaluation of independent regulators. So this body of experts should publish the guidelines for evaluation of independent regulators, and based on these guidelines, government should consult the respective department related standing committee, and it should fix the principles on which these regulatory institutions should be evaluated. So this is also an important suggestion to improve the functioning of regulatory bodies. This suggestion we can write in addition to the suggestions that we have studied in the previous slides. Then uniformity in appointment, tenure, and removal of the members of regulatory bodies. This can be done. There should be uniformity in appointment, removal, and tenure. And there should be a management statement that is published by each ministry for publishing guidelines with respect to the role of the regulator. Also, one important point is that before we set up a regulator, we should assess whether the policy regime in the concerned sector, is it such that the regulator will be actually better placed to deliver on its objectives. So are the policies in that sector such that if the regulator is established, it will function very effectively and it will improve the sector. If establishment of regulator is not actually improving the sector but creating problems, then there is no need to establish the regulator. First, we should actually assess whether there is a need for regulator or not. So these are certain points for improving the functions of regulators. Also, the coordination mechanism for regulators, they need to be proper. Existing coordination mechanisms are like there is a committee of secretaries or cabinet committees which ensure that all regulators are following a uniform pattern. So they help to coordinate the working of various regulators. So these coordination mechanisms, they should be strengthened. And every statute that is creating a regulator, every law, parliamentary law that is creating a regulator, it should include a provision for regulatory impact assessment. That is the cost benefit analysis of the impact of the activities of the regulator. This is the regulatory impact assessment. So every statute that is creating a regulatory, it should have a provision of regulatory impact assessment. So these are certain suggestions for improving the functioning of regulators and the problems affecting regulatory institutions. We have already studied them in detail in the previous slides. Now the second question. For achieving the desired objectives, it is necessary to ensure that the regulatory institutions remain independent and autonomous. Discuss in light of the experiences in the recent past. So there is a necessity to ensure that regulatory institutions, they remain independent and autonomous. So discuss this in light of the experiences in the recent past. This was a question that was asked in UPSC 2015 exam. Now in this we can include many of the points that we have included in the previous question. First is, are the regulatory institutions really independent and autonomous? See, first you write the introduction. In the introduction you can write that after the liberalization, privatization, globalization reforms, new form of economic governance was introduced. And there was a need for independent regulatory regimes so as to insulate the economic decision making from political control. So this can be your introduction. So in your introduction, you can write that after the LPG reforms, there was a need for a new form of economic governance for insulating the economic decision making from political control. Then you can talk about the regulatory complexity at present, because there are a plethora of laws, too many laws governing many regulatory agencies. There is huge variation in appointment, removal and tenure of functionaries of various regulatory authorities. Now, then there is no uniformity in appointment tenure. There is overlapping of jurisdictions. And at present, there is interference by central government, because as we have already seen in agencies like the Sebi, in regulators like Sebi and IRDA, the removal of members is completely under the control of central government, appointment and removal. In case of the Central Electricity Regulatory Commission, on recommendation of the Union government, the Supreme Court conducts an inquiry, and after that, the members are removed. So there is too much of power concentrated in the central government, because of which the regulatory institutions are not able to be fully autonomous. Also, they are not able to be fully autonomous. Also, the budgetary allotment. In case of budgetary allotment, in case of staff appointments, the regulatory bodies need to report to the government departments. Budget is controlled by the government departments. So this is also compromising the independence of the regulatory bodies. In order to attain functional autonomy, the regulatory bodies need financial autonomy. This is adversely affecting the independent and autonomous functioning of the regulatory bodies. Now we can talk about, we have already talked about the problems. Now we can talk about the solutions. The solutions we have already discussed in this previous question. What are the solutions? One is that first, before setting up a regulator, assess the need for regulator, whether the policy regime in that sector is such that the regulator would be better placed to solve problems in that sector. Second point is each ministry publishing a management statement which are a set of guidelines regarding the role of regulator. Third is there should be uniformity in appointment, tenure and removal of members of regulatory bodies. Then fourth is that a body of outside experts should propose guidelines for periodic evaluation of the independent regulators, and based on these guidelines, government in consultation with the department related standing committee should formulate principles for working of regulatory bodies. And also the annual reports of the regulators, they should include the report of their performance on these principles. So annual report of the regulators, they should include the report regarding the performance of regulators on these parameters on these principles which have been set by the government and department related standing committees based on guidelines formulated by outside experts. So this point, that is the sixth point, regarding the annual report of regulator involving the performance of the regulator on certain set parameters that have been first set by a body of independent experts. This can be included in the first question also, that is the problems affecting regulatory institutions and suggestions to improve their functioning. So these are certain. Then the coordination mechanism should be strengthened. We have already discussed in the previous question. The existing coordination mechanisms like the committee of secretaries, like the cabinet committees assisted by secretary coordination, they should be strengthened in order to bring about a uniformity in the institutional framework for all regulators, so that all regulators follow a uniform pattern. So strengthen the coordination mechanisms. This is another point. And also we can include the provision that each statute creating a regulator should have a provision of regulatory impact assessment. So as we have seen the points from the first question, they can be included in the second question also. And finally, we can talk about the conclusion. In conclusion, you can write that since it is the responsibility of the regulator to meet the objectives which have been set up for the regulator, the onus of meeting the regulator's objectives lies with the regulator. So the government cannot be allowed to have unbridled discretion in how the regulator hires and manages its personnel and how it uses its finances. This is what you can include in the conclusion. So in the conclusion, in simple words, we can say that since it is the responsibility of the regulator to meet its objectives, so the government should not be allowed to interfere too much in the functioning of the regulator. Now we come to the third question. Now the third question is regarding the functioning of the Competition Commission of India. Third question says, discuss the role of the Competition Commission of India in containing the abuse of dominant position by the multinational companies. So role of Competition Commission of India in containing the abuse of dominant position by the multinational companies in India. Now, the Competition Commission of India, as we know, it is the regulator of the It regulates the various mergers and acquisitions between different companies. It works to ensure that there is fair competition in the market. It works to stop the anti-competitive agreements. Recently, the Competition Amendment Act has also been passed in 2023, which has strengthened the Competition Commission of India. And this act, it has reduced the time limit within which the CCI is required to conduct its investigation. It has reduced the time limit from 210 days to 150 days. And it has also introduced certain provisions, certain additional provisions, like in the Competition Act, the earlier Competition Act, which will serve to strengthen the regulation by the Competition Commission of India. Now we are going to discuss the role of Competition Commission of India in containing the abuse of dominant position by multinational corporations in India. Now, under Article 19, Clause 1 of the Competition Act, the Competition Commission of India, it is empowered to start inquiries. Either on its own suo motu or based on complaints or information received from various stakeholders or references from government authorities. So it can start inquiries on its own or on the basis of information from various stakeholders. Now, in case of WhatsApp privacy probe, so this Commission of India, it initiated an inquiry citing a prima facie case of abuse of dominance, ensuring data privacy and fair competition in the digital space. So it took WhatsApp to task for abusing its dominant position, and it launched a probe into the practices by WhatsApp. It says that WhatsApp was violating the norms of fair competition. Then Commission of India, it reviews the mergers and acquisitions between various companies. Now, in case of regulating of mergers and acquisitions, recently the new Competition Commission of India amendment regulations have been competition amendment regulations have been passed in 2023, and according to these, the CCI will be regulating the companies which are the merger and acquisitions of companies having assets of 2,000 crore, having assets of 1,000 crore or more, having turnover of 3,000 crore or more, and also when one company is acquiring the other company, the assets of one of the companies should be at least 1,000 crore, and the company being acquired should have a substantial presence in India. These were certain new provisions in the Competition Amendment Act of 2023, and also, so the Competition Commission of India is regulating the mergers and acquisitions. Now, these provisions we don't need to write as part of the answer to this question. In this, you can just write a simple point that Competition Commission of India is regulating the mergers and acquisitions. Then next thing, it ensures fair competition. The Competition Commission of India had ruled against Google because Google was abusing its dominant position in the market, and Google was imposing restrictions on the device makers and Google was saying that if the device makers, they have got Android on their phones, so they should compulsorily have the Google search engine. So this was an unnecessary restriction. So CCI ruled against Google, directing it to remove restrictions on the device makers to promote fair competition in the Android market. So what Google was saying was that the mobile manufacturers having the pre-installed Android system on their phone, they should compulsorily have only the Google search engine. They can't have another search engine. So this was an anti-competitive practice. So CCI ruled against Google in this case. Then CCI also promotes consumer awareness. Also, the CCI issues orders and directions. Orders and directions under the Article 19 Clause 4 of the Competition Act. So under this, CCI can pass orders, issue directions, and also impose penalties. It can impose penalties. For example, the CCI imposed penalties against the Axis Bank. It imposed a penalty of 40 lakh on Axis Bank for not notifying its acquisition of CSE e-governance. So Axis Bank had not notified its acquisition of the CSE e-governance and had violated the competition regulations. So a penalty of 40 lakh was imposed on the Axis Bank for not notifying its acquisition of the CSE e-governance. Then under Article 19 Clause 5 of Competition Act, the orders and directions of the Competition Commission of India, they are binding. They are binding in nature. And the Competition Commission of India had recently imposed a penalty on Coal India. It had imposed a penalty of 1,773 crore on Coal India for abusing its dominant position. Now this is the role of CCI in containing the abuse of dominant position by MNCs. So this is what you can write in this question. Now what are the challenges before the Competition Commission of India? One of the challenges is that the digital landscape is evolving, it is changing, so CCI needs to adapt to the evolving digital landscape. It has to align itself with the new digital legislations. Also, there are a lot of pending orders, and CCI needs to resolve these pending orders. Also, the CCI needs to stay updated with the technological advancements. There are a lot of technological advancements, and the Competition Commission of India needs to stay updated with them. So these are certain challenges before the Competition Commission of India. So we have discussed in detail 3 questions. One is regarding problems affecting regulatory institutions and the suggestions to improve. The second regarding the issue of independence and autonomy of regulatory bodies, and the third regarding the role of Competition Commission of India in containing the abuse of the dominant positions by multinational corporations. Now before we end this video lecture, we will also talk in brief about the Telecom Regulatory Authority of India. So Telecom Regulatory Authority of India is regulating the telecom sector. And the TDSAT, that is the Telecom Dispute Settlement Appellate Tribunal, it is an appellate body in the telecom sector. This Telecom Regulatory Authority of India imposed certain rules regarding net neutrality in the year 2018 in order to promote fair practices in the internet space, so that no actor can abuse its dominant position, so that all the actors on the internet, they are provided a level playing field. Because at that time Facebook had started its free basics program, which was violating the net neutrality norms. And also the Airtel Zero by Airtel was violating the net neutrality norms. So TRAI passed a set of regulations in 2018 to ensure net neutrality and to provide a level playing field to all the players in the internet space. So In this video, we have studied in detail about the role of regulatory bodies, the problems associated with regulatory bodies, that is the issues with regulatory effectiveness, and the suggestions to improve the functioning of regulatory bodies, along with studying in detail about the Sebi-Hidenburg controversy, about the issues with Sebi, and also the suggestions to improve the functioning of Sebi. With this, we come to the end of this video lecture. Thank you.